Before we talk about loan rules or paperwork, let's start with something I see all the time. I recently spoke with someone who had been self-employed for years. Their business was doing well, money came in consistently, bills were even paid, and savings were growing. But every time they applied for a mortgage, they heard the same thing. Their income could not be used the traditional way. They were confused because their bank accounts were clearly showed they were financially stable. The gap between real life and paperwork is exactly why the non-QM bank statement loans exist. Instead of judging income only by tax returns, this loan looks at what actually goes into your bank account. Once we shifted to that approach, everything finally made sense. Hi, I'm Kelly Arriaza, your mortgage and home loan expert with Nexa Mortgage. Today, I want to talk to you through what a non-QM bank statement loan is, who it is designed for, how it works, and why it has become such a popular option for buyers who earn income outside the traditional structure. Understanding the basics of a non-QM bank statement loan. To really understand why this loan works so well, it helps to start with the basics. A non-QM bank statement loan is a type of mortgage created for people who do not earn income in a traditional W-2 way. Instead of using tax returns, lenders review 12 or 24 months of bank statements to understand how much money you actually earn. They look at the deposits' consistencies and patterns over time rather than what is left after deductions and write-offs. This helps paint a much clearer picture of the real income. These loans are still fully documented and carefully reviewed. The difference is not in the level of scrutiny, but in how the income is shown. For many self-employed and commission-based earners, this feels far more realistic and fair. Well, who benefits from most of the bank statement loans? Once you understand how the loan works, the next question is who it actually helps the most. This loan works especially well for self-employed borrowers, business owners, freelancers, 1099 contractors, and commission-based earners. Many of these borrowers make good money, but reduce taxable income through legitimate business expenses. Traditional lenders often struggle with that, but a bank statement loan does not. It is also helpful for people with income that changes month to month, but stays consistent over time. Many of these buyers are purchasing a home to live in, not investment properties. These loans is not just for the investor, it is for real people whose income simply does not fit into a neat box. How you qualify using the bank statement loan. Now let's talk about what lenders actually look at when they review your file instead of a tax return. Lenders analyze either 12 or 24 months of bank statements. These statements can come from a personal account or a business account, depending on the program. The lender adds up all the deposits and averages them to determine the monthly income number. When the business accounts are used, an expense factor is applied to estimate operating costs. This can be done using a CPA letter that outlines reasonable expenses or by applying a standard expense percentage when no CPA letter is provided. Using 24 months of statements usually strengthens the file and often results in a better pricing because it shows stability over time. Clean deposits matter. Consistent income matters and keeps business and personal accounts separate. Makes the process much smoother. Most programs look for credit scores around 620 or higher, and down payments often start around 10% and better terms available for stronger profiles. Purchase or refinance options. Another reason this loan is so popular is how flexible it is in real life. A non-QM bank statement loan can be used for both purchases and refinances. Buyers can use it to purchase a primary residence, a second home, or an investment property. Homeowners can also use it for rate and term refinances or cash out refinances, depending on the program. This flexibility makes the loan useful at different stages of home ownership. Whether you are buying your first home, upgrading, or restructuring existing debt to create more monthly breathing room. Property types that work with the bank statement loan. Beyond how the loan is used, it helps to know what kind of homes qualify for the bank statement loan. Bank statement loans allow for a wide range of property types. These include single-family homes, condos, townhomes, and duplexes, with some programs allowing up to 4 units. They also work for second homes and rental properties. This gives buyers more freedom when searching for the right home instead of feeling boxed in. Why borrowers choose bank statement loans at this point? Many borrowers ask why someone would choose this loan over a traditional option. Borrowers choose the bank statement loan because they reflect real life. They do not punish smart tax planning or force business owners to change how they operate just to qualify. Instead, they focus on actual cash flow and financial responsibility. For many self-employed buyers, this loan feels like the first time the system truly understands how they earn money. Understanding the trade-offs. Of course, it's important to talk about honesty about the downside as well. Bank statement loans typically have a slightly higher interest rate other than traditional loans, and the down payment size plays a big role in pricing. Expense factors also affect how income is calculated, which is why clean documentation matters. Even with these trade-offs, many borrowers feel the benefits outweigh the cost, especially when the alternative is waiting years or missing opportunities altogether. How smart buyers use bank statement loans strategically. When used the right way, this loan becomes part of a long, smart term plan. Many buyers use bank statement loans as a stepping stone. They buy now, continue growing the business or income history, and refinance later when traditional options become available. Others keep the loan long term because it fits how they earn and manage money. There is no one right approach. The best strategy depends on the goals and timeline. Built-in structure and oversight. One thing people often don't realize is how structured these loans actually are. Bank statement loans today are regulated and carefully underwritten. Lenders review credit history, reserves, income patterns, and overall financial behavior. The flexibility is in documentation, not in lowering standards. That is what makes this loan responsible and sustainable. Bonus tip: know your plan before you choose. Before moving forward, it helps to pause and think through your plan. Consider how consistent your deposits are, how organized your accounts are, and whether you plan to refinance later or keep the loan long term. Going into the process with clarity makes everything smoother and far less stressful. Now let's bring it all together. When you take a step back, the big picture becomes clear. A non-QM bank statement loan is not a shortcut. It is a modern solution for modern earners. It recognizes that income does not look the same for everyone and that real cash flow deserves real consideration. Used the right way, it helps buyers move forward with confidence instead of feeling stuck. If you are self-employed, run a business, or feel like your tax returns do not show the full picture, I would love to help you explore whether a non-QM bank statement loan makes sense for you. You can call or text me at 801-548-0162. Or feel free to email me at Arriaza@nexamortgage.com. Feel free to also visit my website, kellyyourmortgageexpert.com, and schedule a free consultation.